Thank you ever so much for coming. I'm Paul Johnson, Director of the IFS, and you're all very welcome at this, the third in our series of 50th anniversary events that we're running this year, the IFS having been founded back in 1969. So I'm very pleased that we're running this series of events. The first one was on working age welfare, the second one on tax, and this one today on incomes in retirement, the future of income in retirement. We've got two more later in the year, one on education and one on public spending and the future shape of the state. So we're going to cover quite a lot of ground through the year. Tonight, the main talk is going to be given by my colleague Carl Emerson, who will talk for 20 minutes or so on incomes in retirement. As you'll see, not all about retirement, some about incomes that older people earn. We'll then move on to a panel discussion. I'm delighted to be joined by two very distinguished people who are hugely expert in this area. The first is Professor Sarah Harper, who is the Claw Professor of Gerontology at the University of Oxford and the founding director of the Oxford Institute for Population Aging. She's got a remarkable CV, which includes a period as Professor of Public Policy at the University of Chicago. She was at one point the director of this institution. She initially trained actually as a journalist with the BBC and has carried out a huge range of appointments and advisory work for government and the private sector. So the sort of CV that makes one feel deeply inadequate. The second speaker, on the other hand, is has spent 20 years in Parliament, which one might not be so jealous about, or nearly 20 years. It's Sir Steve Webb, who is currently Director of Policy at Royal London, and Steve is this evening's IFS alumnus. In fact, my first boss when I joined the IFS for the first time a long time ago. I haven't been there all of that time. Steve is here, secondly, because he was Pensions Minister between 2010 and 2015, and I think generally recognised as probably, and I'm going to be nice to him now, the most effective Pensions Minister that we've seen. The lesson clearly being that the Cabinet needs to be staffed by IFS alumni. But without further ado, I will hand over to Carl Emerson, and we will then have a panel discussion and then open it out to you to ask questions and make contributions. Thank you.
Thank you, Paul. So, as Paul just said, we're going to hear shortly from Steve Webb, who's the architect of the current state pension system. So in preparation for this talk, I thought I would start by looking back at the Beveridge Report, who was one of the architects of the original, or the state pension system that we had for many decades before Steve got his hands on it. So this was published in 1942, and reading through the report, there were three things that particularly struck me about what it proposed. One was that we should have a pension paid to people in retirement that was adequate for their subsistence without other means. So this would mean that somebody who had a full contribution record, and Beveridge was largely referring to men who'd worked throughout their careers, would receive a pension from the state in retirement that meant they could live not in poverty. He didn't think there should be a means-tested payment. He was very worried about incentives to save. He felt it should be available to all who'd got that contribution record. Secondly, he was interested in this being a retirement pension, not an old age pension. So it was to be payable to people who had in fact left the labour market. They had in fact retired. But that's not to say he wanted to encourage people to leave the labour market. He was worried about that. He felt that people who could work for longer should be encouraged to, and they should be told that their state pension would be more generous if they stayed in work beyond the normal state pension age. And in setting the rate of the benefit, he said that if you got the maximum amount, you should get the same rate of benefit that would be available to somebody of working age who was out of work. So somebody who was out of work on a disability benefit or on unemployment benefit. And I'm going to return to each of these 3 points as I move through the talk. Now, the state pension system that was introduced following the Beveridge Report wasn't the same as he proposed, but it was along those lines, and much has changed since then. Perhaps the biggest change has been what's happened to longevity at older ages. It's risen remarkably, and it's risen in a way that we hadn't expected at the time. So if you take a man who was born in 1900, who'd made it to age 50 in 1950, he would expect to be getting a state pension from the age of 65. Well, in fact, 50-year-olds in 1950, 25% of them didn't make it to the state pension age, but on average, they made it to 73. So that would be, on average, 8 years of receipt of the state pension. Now, in the period since then, as I've already said, longevity at older ages has risen sharply, so a great thing. People at older ages are expecting to live longer and longer. And of course, the male state pension age has also recently started rising. It's now above age 65. And current government policy is that if longevity continues to rise, we'll continue to push up the state pension age, perhaps in line with what I've indicated on this chart. So if we take someone who was born in 1970, they'll be approaching age 50 in the next couple of years. They're going to have a state pension age perhaps of 68, so quite a lot higher than what was previously the state pension age. But they're going to get a state pension on average for 18 years. So that's a much bigger change, a much bigger payout period than what was intended back in 1950. And I think arguably we had a bit of a design flaw in our state pension system back in 1950. Perhaps what we should have done with the benefit of hindsight is automatically said then, well, if longevity increases a lot, we will start to increase the age at which you can get this state pension. And perhaps some of the problems we're going through at the moment is because we didn't do that then. And in fact, actually, we had a design flaw perhaps in our private sector pension arrangements too. Many employers in the private sector were offering final salary pensions. They paid out that pension from a fixed normal pension age. Again, with the benefit of hindsight, perhaps we'd have liked it if those normal pension ages had in some way been related to what the prevailing longevity at older ages was at that point in time. For women, we get quite a different picture. If you're a woman born in 1900, made it to 50 in 1950, you'd have a state pension age of 60, but you'd on average be expecting to live to your late 70s. So you'd be expecting to get a state pension on average for 19 years. Longevity amongst older women has been rising too. It's not risen as fast as it has for older men. The gap between the two is narrowing. And of course, we've pushed up the state pension age for women much more. It's now aligned with the male state pension age and is set to go up along with it going forwards. So if we take a woman who was born in 1970, she'll be turning 50 in the next couple of years, her state pension age will be 68, she'd be expecting to get that on average for 20 years. So it's still more years of receipt than what was intended back in 1950, in the middle of the last century. So big changes in longevity over this period. So I'm going to pose 3 questions in this talk. The first one is, what's happened to pensioner incomes over this period? How have we coped with that increase in longevity? What's been happening to the incomes of poorer and middle-income pensioners? And I'm going to start with what's been happening to low-income pensioners. So in this chart, I'm going to look at the incomes of individuals according to their household income after housing costs, and say what proportion of them are living in a household where the income is below 60% of the median in that year. And I'm going to start the data in the late 1960s. This was a dark era. We didn't even have an IFS in those days. And if you look at the working age population, about 10% of the population was in poverty on this measure. If you look at the older population, amongst those older groups, about 40% of them were living in a household where their income was below this poverty measure. So a level of poverty amongst pensioners that many would have described as unacceptable. If we roll forward to the mid-1990s, poverty amongst working age households had risen, but amongst pensioner households, it had started to fall. And if we roll forward to the most recent data, we can see that actually, on average now, a pensioner is not more likely to be in poverty than a working age person. On average, they're slightly less likely to be in poverty after you adjust for their typically lower housing costs than a working age individual. So in terms of Beveridge's desire to have pensioners not living on a subsistence level of income, we're actually much more successful at this today than what we were, for example, in the 1960s. And this represents a big success in terms of state pension policy, in terms of private pensions, at getting income to people during their retirement phase. So that's the poorest pensioners. What's been happening to sort of more standard pensioners, the average pensioner income? What if we now look at the median income amongst pensioners and compare that to the median income amongst non-pensioners? And again, if we adjust that for housing costs, the chart here is going to show you how that's changed over time. So you can see during the 1960s, during the 1970s, during the 1980s, average pensioner incomes were around 2/3 to 3/4 of average non-pensioner incomes. But since then, we've seen a remarkable change. Average pensioner incomes have grown much faster than the average incomes of non-pensioners, such that in the most recent years of data, we see a situation where, on average, pensioner incomes after housing costs are running at about the same level of those for non-pensioners. So again, a successful period in terms of delivering incomes to those above the state pension age. And I want to dig a little bit more deeply into what's been driving that increase in income since the mid-1990s. So for this, what I'm going to do is take 60 to 74-year-olds. So that's a group of people who are approaching the state pension age or a few years above it. And I'm going to take those in this age group who are in the middle of the income distribution. So they're in the middle fifth of the income distribution within that age band. And back in the mid-1990s, before that strong growth in income that I just showed you, their average incomes were about £300 per week. Over the subsequent period, their incomes have grown pretty dramatically, an average of 2.2% per year. So what's been driving this increase in their incomes? Well, one driver has been increases in income from the state, from benefits and from the state pension. And you might be surprised, we've obviously increased the female state pension age a lot over that period, making the pension system less generous to one group of people aged 60 to 74. But we've also had lots of other reforms working their way through, which have made the state pension system more generous. The state earnings-related pension scheme was introduced in 1978, but it was at its most generous for people who reached the state pension age around 2000. We've also seen successive reforms which have improved the coverage of the basic state pension, in particular for married women who'd had children, so driving up the coverage rates. Women are now much more likely to get to the pension age entitled to a full state pension than their predecessors were. The second component of income which has grown pretty strongly is income from private pensions. So that could be people who worked in the public sector, getting a pension from their former employer there, people who worked in the private sector, perhaps getting a final salary pension, people who worked in the private sector and getting a defined contribution pension. And you can see that on average over this period, the incomes of these 60 to 74-year-old middle-income pensioners from private pensions has increased by about 3% per year on average. And of course, this might be a source of income where we're really worried about the prospects for future generations. Those public sector pension schemes aren't as generous as the ones that preceded it. But in particular, for private sector employees, younger people are not entering their employment and being offered the chance to join a final salary pension that comes with it a very generous employer pension offer. We have got automatic enrolment. It is getting many, many more employees in the private sector into private sector pensions, but the amounts going in for most of those people are pretty small. And of course, even if you get to, say, the state pension age with a certain pension pot, if you're going to live longer, you've got more years to spread that pot over. So the prospects for this component of income growing anything like as strongly in the future, I think, are pretty slim. So what's the rest of this income made out of? Well, actually, and perhaps surprisingly, it's earned income. And this has been growing substantially for this group. So amongst these 60 to 74-year-olds, the amount they get from earnings has grew by an average of over 4% per annum over this period. So back in the mid-1990s, this component of their income was about 15% of their total income, and it's risen today to 25%. So I'm going to argue that actually there's perhaps much more scope for future generations of 60 to 74-year-olds. Whoever's giving this talk here in 25 years when the IFS is celebrating its 75th birthday will be talking about perhaps how this component of income has continued growing. So the second question I want to address is, well, how much capacity is there for retirement ages in future to increase further still? And I think the evidence that there's plenty of capacity is perhaps strongest. I'm going to start by looking at how much time people have spent in paid work once they get to age 65, and how much time they expect to spend receiving the state pension. So if we take men here, men born in the second half of the 1920s, on average they're reaching age 65, having spent about almost 60% of their total life being in paid work, and they're expecting to get a state pension for about 20% of their total life. So that's a ratio of years in paid work up to 65 over years of receiving the state pension of about 3. And you can see that over subsequent cohorts, each generation of men is reaching age 65, having spent a smaller proportion of life on average in paid work, and expecting to get the state pension for a larger proportion of their life. That's what happens when longevity increases, when retirement ages don't increase alongside that, and when the state pension age doesn't rise alongside that. So the ratio of the two, which was 3 for those born in the late 1920s, has now fallen to 2. Now, Keynes, when he was writing, made a prediction that continued technological progress, productivity growth would make us richer. We would choose to, therefore, work fewer hours per week. And he imagined a world where we might be working 5 shifts of 3 hours each week, a 15-hour working week. And clearly, we have seen some reduction in full-time hours, but nothing like what he predicted. Perhaps, but what we're partly seeing here is, because we're now richer than we were, people choosing to have a big lump of leisure at the end of their lives. Maybe they'll be working part-time, maybe they won't be in paid work at all. And perhaps we need to ask as a society whether that's how we want to consume the extra wealth that we get to enjoy. Going forwards, with the increases in longevity and the increases in the state pension age that we're expecting, the proportion of male life spent receiving the state pension will remain roughly constant. For women, we get a very different picture. What we actually see is that because successive cohorts of women have been entering the labour market, have been more attached to the labour market, while their longevity has been rising, actually the proportion of their life spent in paid work has actually been going up. So the ratio of proportion of life spent in paid work to number of years receiving the state pension has actually been pretty stable for women. It hasn't been falling in the same way as it has for men. And of course, going forwards, because we've been increasing the state pension age for women more than what we've increased it for men, because of its lower starting level, we're going to see that proportion of life that women get the state pension for declining over the next few years. So let's return to look at capacity for work amongst older men. So if we take 55 to 59-year-olds and we take 60 to 64-year-olds, the chart here is showing their employment rate over time. So you can see that in the early 1980s, a big drop in employment of older men. And then since the mid-1990s, you can see that employment rates of these older men has been rising almost continuously over this period. And if you look at the older group of men, men who are receiving the state pension, so unlike what Beveridge suggested, we have men receiving the state pension and in paid work, you can see that also fell to the mid-1990s and then rose. But actually, for the 2 younger groups of men on this chart, their employment rates today are still quite a lot below the levels they were at in the mid-1970s. And you might also think that jobs in the UK economy today might be more amenable to people at older ages than many of those jobs were in the 1970s. So, for example, if you ask men who are in work at the ages of 60 to 74, does their job require physical or heavy manual activities, the majority, 60% of them, report that it doesn't. And in terms of their health, it's very difficult to get a very consistent health over time, a measure of health that's measured in the same way. One thing we do measure very accurately is whether somebody is dead or whether they're alive. So if we take a 55 to 59-year-old man back in the mid-1970s, well, actually 1.5% of them died in the next year. If we roll forward to today, that same age group has a mortality rate of 0.6%. Amongst the older groups, and in fact, if you take the oldest group on their chart here, their mortality rate, their 1-year mortality rate is 1.4%. So at least on this measure of health, the 65 to 69-year-olds are healthier today than what 55 to 59-year-olds were in the mid-1970s. So on this measure of health, a 65 to 69-year-old man is healthier than a man aged 55 to 59 in the mid-1970s, but he has a much, much lower employment rate. So if you'll indulge me a bit, supposing we went through the following scenario where 65 to 69-year-old men today were just as likely to be in paid work as 55 to 59-year-old men were in the mid-1970s, well, if that happened, you'd have 1 million more older men in the labour market. Now, I'm not arguing that these men should work, but I'm arguing that for many of them, there'll be the capacity to work should they wish to. Now, for women, the picture is a little bit more complicated. We see pretty flat employment rates amongst older women up until the mid-1990s, and we see rising employment rates since then. So for all of these groups, the employment rate for older women is at its highest level for this period, and possibly at its highest level ever. So is there extra capacity for these women to work more? Well, their employment rates are still below those of men of the same age, so that might suggest that they are. And actually, if you look at younger cohorts as they're approaching these older ages, they have greater employment rates, and they have higher levels of education, they have greater employment rates. So that again points to the possibility that we can expect these employment rates to continue growing for some time. In terms of the jobs that these women do, if you take women aged 60 to 74 who are in paid work, 80% of them report that their job does not require any physical or heavy manual activities. And in terms of their health, if you look at that one-year mortality rate, you can see that while the improvements in mortality for older women aren't as great as what we've seen for older men, you can see that the one-year mortality rate for the oldest group of women on this chart now is pretty similar to that one-year mortality rate for the 55 to 59-year-old group was in 1975. Perhaps the strongest evidence that suggests there's increased capacity to work for these older women is to look at what happened when we increased the state pension age. If there was no capacity, you wouldn't see women respond by staying in the labour market for longer. And actually, the period where we've been pushing up that female state pension age from 60 in 2010 has been the period in which you see the female employment rate rise the sharpest on this chart. So you do see some women respond to the higher state pension age by staying in work for longer. So I think actually for both men and women at these older ages, there is capacity for more of them to work in the future. But I think that raises the question about, well, what should we be doing about those who can't retire later? In particular, in the context of pushing that state pension age up, I think maybe policymakers should be worrying more about those who are below the now higher state pension age and who can't respond by staying in the labour market for a few more years. So to start, I'm going to look at the health of those aged 60 to 74 again and say how many are not in good health. And amongst all men and women in this group, about a quarter are saying that their health is only fair or poor. So they're saying their health is not good. And in fact, 1 in 6 of this group who are in work, who are in paid work, say that their health is not great either. But policymakers might want to be particularly worried about the 30%, a substantial minority, who are not in paid work and say that their health is not good. There may be many in this group for whom extra work just isn't possible. And this really matters, and the reason it really matters is actually our tax and benefit system becomes much more generous to you the moment you hit the state pension age. We are much, much more generous to people just above the state pension age than just below it. So if you push up the state pension age, it really can have a detrimental impact on those who can't respond by working for longer. And I'm going to demonstrate that by looking at the rates of 2 different benefits in our system and how they've changed over time. So if we take job seekers allowance, so this is the out-of-work benefit to which the working age population might claim, you can see that, broadly speaking, it's kept pace with inflation over the period since the late 1980s. It's slightly dipped down at the end because of the benefit freeze. If we contrast that to the main income replacement benefit you can get if you're a poor pensioner, pension credit, you can see that's much more generous, and the gap between the two has been growing. So that in the late 1980s, the premium you got for being a low-income pensioner as opposed to a low-income working-age person was 30%. Now that premium is almost 130%. And you can compare this to Beveridge's comment about wanting to set the rates the same. And actually, this chart is understating the difference. Once you get to the pension age, you can also get winter fuel payments. You can also get potentially a more generous housing benefit than the working age population can. And of course, job seekers allowance comes with a whole load of requirements. You have to seek work to get it. Pension credit has no requirements. So I'm not saying it shouldn't be more generous than job seekers allowance, but as we continue to increase that gap, we might worry more about those who are left below the state pension age who are unable to work. And we see this translate into the incomes of people just below and just above the state pension age. So if we take people who are going to hit the state pension age in the next 5 years, who are in the poorest fifth of that group, you can see that their incomes after inflation haven't really grown over the period since the mid-1990s. If we contrast that to the incomes of people who are 5 years past the state pension age, up to 5 years past it, but again in the poorest fifth of that group, you can see on average their incomes are higher, and you can see that on average that gap has been widening over time. And this is a direct result, I suspect, of policy that's just treating this group much more generously when they get to the state pension age. So in 1999, we had income 17% higher amongst the poor group just above the state pension age than the low-income group just below it. That gap today now stands at 70%. And the final piece of evidence on this kind of big increase in generosity at the state pension age and how it really matters comes from looking at households and how they coped with the increase in the female state pension age. We can look at what happened to their household incomes as a direct result of that change in the state pension age. And if we look at what happened to incomes in the middle of the distribution, so this is when you push up the state pension age, what happens to your income if you're now below it? Well, incomes at the middle of the distribution were reduced on average by about 11% as a result of that change. So some people responded by staying in work, but we're not paying a state pension to those people, and on average people were left worse off, and the hit was 11%. But we can also look at how that varied across the income distribution, and for those at lower percentiles, you can see the reduction in their household income was bigger. So at the 10th percentile, the hit to household income from a 1-year increase in the state pension age was 21%. So to conclude, since the mid-1990s, we've seen strong growth in pensioner incomes, and a big driver of that has been increased earned income. This group has done well from private pensions income over this period, but earnings have been the biggest driver of growth in their incomes. And I think this really matters because for future generations, I think, and this is probably an understatement, they're not going to benefit from the same growth in generosity of state and private pensions. They're not getting into the same kind of final salary pensions. They're not experiencing the same kind of earnings growth. They're not getting the same kind of long-term returns. So there's lots of reasons to think why they'll get to retirement and not have as much resource squirreled away in private pensions. But I think there is much more capacity for employment rates of older men and women to continue rising. They have already risen since the mid-1990s, and I hope that I've presented strong evidence to suggest why this might continue over subsequent years. But one thing I think policymakers need to worry more about is this gap in generosity between how we treat people just below the state pension age and just above it, and whether as we increase the state pension age further, we might worry that this gap in generosity, this growing gap in generosity, might just be seen as being increasingly unfair on those who, for whatever reason, just can't retire later. Thank you.
Thanks ever so much, Carl. That was a great presentation and a lot of food for thought in there. We'll come back to some of what you were talking about in a moment, but of course Carl was focusing very much on the younger old, as it were, and I thought it might be worth starting this discussion by reflecting a bit on some of the challenges that might be facing the older or people as they get towards later life than 75. So I'll turn to you first, Sarah, if that's okay. Maybe you could just say something about what you see as some of the challenges that go beyond the age groups that Carl's just talked about.
Yes, and I thought I thought that was a fantastic presentation, and one of the really key things, of course, that you brought up is the inequalities. And I think one of the problems we know we have is that, if anything, inequalities in later life are getting wider. So we've been talking about life expectancy continuing, and remember, we now have half our population in this country making it to 80. And as a consequence, when we look at the oldest old, which are those basically the 80 to the 85 plus, the inequality we find in need, if anything, is just considerably widening. One of the issues that has been recently highlighted is that actually life expectancy seems to be flattening. And we think one of the reasons life expectancy is probably flattening is that if you actually look at what the ONS figures are, and in fact they've just had another release recently, are actually saying is that although among the higher groups we're having increased life expectancy, among the lower groups in terms of income and also education and also where they're living, if anything, particularly for women, it isn't just flattening, it's beginning to fall. So I think going forward, we can say that we know at the aggregate level, even if life expectancy increases, what's going to happen to healthy life expectancy? And one of the really important points that you made is it's extremely difficult to project healthy life expectancy. So as a society, we really are unclear what's going to happen to life expectancy going forward. We know things like growth in obesity at all ages can actually reduce healthy life expectancy at the national level by up to 6 years, which is absolutely striking. Obviously, there's a huge variation between the type of obesity, but survey and study after is saying, and that's because it just increases the chronic morbidities. So in other words, we live with cardiovascular disease, we live with stroke. So for an individual who's trying to plan for those later years, that becomes very difficult. So at the moment, if you are 65 and you are thinking of planning for when you get into your 80s, on average, we're saying that at the moment, and we have a social care green paper that is still on hold, but I'm sure eventually it will come out. But the data, have been very involved in that, and the data that we produced for that showed that on average at the moment, a 65-year-old on average can expect possibly to have care costs of around 40,000. Of course, some of those will be personal care costs, some of those will be means tested. But 10% of the population may personally have to find up to 100,000. And 25% of the 65-year-old population, possibly looking at their old age, will have nothing. So I think not only is there huge variation, but it's very difficult for both an individual and for society to be able to understand what that variation is, and therefore it's very, very difficult for individuals to be able to plan for that.
And I think that's one of the biggest challenges, isn't it? I mean, we talk about a pension system and we talk about the Beveridge Report and so on. And actually the costs are being pushed further into later life, and we still haven't really defined a role for the state that supports people, I think, in the way that Beveridge would have intended through an insurance system.
Yes, and of course, I mean, one of the important things is that, in theory, if we work longer, then not only does our income for later life become increased, but we know that there's a relationship between staying in work and healthy, active retirement, although obviously there is a sort of health reason behind whether or not you retire. But increasingly, the state is pushing the care responsibilities onto that middle group. And so if you look at people aged between 50 and 64, we know that if you are a full-time carer, and given that their parents, obviously life expectancy has increased, if you are a full-time carer, then your chances of being in work between 50 and 64 are actually reduced for both men and women by about 10%. And also, your chances of being in part-time work are quite considerably increased. So we're pushing the responsibility for caring for our older population onto that mid-group, which really should be working, if they can, full-time in order to be able to increase their late-life income, and yet the care responsibilities are obviously going to be one of the reasons why they may not be able to.
The whole thing feels to me like a failure of the welfare state to adapt to a dramatic change in demography.
Absolutely, and I think one of the things is that we still have this sort of 20th century mindset, I mean, clearly one of the positive things has been that late life income for most pensioners has gone up. This is a slightly different topic, but I think a real fear at the moment that we know there is this real push for intergenerational equity, and I think one of the fears is that, as Carl so rightly pointed out, if anything, we may well not see, for all sorts of reasons, that continued increase in pensioner income. And if we are going to have policies that try to directly redistribute income towards younger populations, who of course have got many decades of making up that income, and take it away from our pensioners, then, if anything, we could see a return to pensioner poverty in the way that we have seen in the past. And remember, I think at the moment, the projections are that we will have a third of our population who are still on state pension. So although we have increased, obviously, the occupational pensions and the private pensions, we still have a large proportion of our population who are reliant on those policies that may be tinkering with the state pension.
Well, let me turn to Steve then to ask about this issue of incomes in retirement going forward. In particular, Carl made the point several times, and Sarah has as well, that there must be quite significant worries about the role of private pensions going forward. I mean, they played such a big role in increasing incomes up till now, but with the collapse of occupational schemes, perhaps not so much in the future.
There is a chart which I call the most important chart in pensions, and it shows the death.
Why wasn't it there, Carl?
The death of DB and the rise of DC, and unfortunately, the DB tide goes out before the DC cavalry comes over the hill, and there's this gap in the middle. Brackets with something quite different going on in the public sector. There's a whole set of public sector pensions aren't perfect, but they're still DB, and so that's an issue. But I do think there is an issue where actually, if I think about my 20-something-year-old kid, I can't remember how old they are, but my 20-something-year-old kids, assuming they ever get a job, then they'll get potentially 50 years of contributions at 8% or 10% or whatever it is, plus a £9,000 state pension. They'll kind of be all right. It won't be fantastic, it won't be what their grandparents had, but it will be kind of all right. And I think about the people coming up to pension age now, and again, sweeping generalisation, but many, as per your slides, are doing relatively well on average. It's that group in the middle, actually, who I think the current policy on auto-enrolment gets them in. They missed DB, they didn't really get going on DC, and I don't actually trying to come up with a clever policy. I guess that's what you do for a living, Paul, these days, but if you can fix that middle generation, that would be a real achievement.
Well, Pensions Minister. Let's just explore the sort of the optimistic bit of what you just said, which is that the younger generations will be fine, broadly speaking. I mean, one of the concerns, I guess, is that if we are in a world in which interest rates remain absolutely rock bottom, and that reflects a whole series of things, including people's perception of risk around the stock market, is even 8 or 10% contributions going to be enough for them to be even just fine, let alone as well off as they might have been in a DB scheme?
Well, clearly not the latter. I mean, but your bitter rivals at the Pensions Policy Institute have done some projections for those leaving school, and if we are going to spend 2/3 of our adult life in work and 1/3 in retirement, then that is a working life for my 20-year-old daughter of 50 years, give or take. Yes, there might be issues about what happens to her private pension if she has a period out of paid work, but in principle, 45 to 50 years, I think 5% plus 3% isn't sustainable. I can't think of anywhere in the world where it's okay for the firms to put less in, so I think we need 5 plus 5. We want that to be 10% of the whole wage. I think 10% of the whole wage plus a state pension that's about 1/3 of the national average wage kind of gets you, as I say, the paradox is most of the folk who policymakers listen to are not those folk. I think the vast bulk of people are kind of going to be okay with a good run of auto-enrolment, but of course all the stuff in the press and all the policymakers are talking to people who are worried about the lifetime allowance, the annual allowance, the stuff which matters, but actually I think for the bulk of the people all that stuff doesn't affect them.
Yeah, I mean, Steve's absolutely right. I've sat in rooms in the Treasury with people from the industry, obviously kind of already way over the lifetime allowance, and that's all they're worried about. What pension freedoms? I mean, one of the things I suppose that concerns me about the future is, to put it possibly a little strongly, is it's not obvious to me we have a private pension system at all. So, we have auto-enrolment into something called a defined contribution pension, but it's actually just a savings pot because you can then just take it and, buy a fast car, for example. But more to the point, people will get to 65 or 70, they won't actually have a pension. And this may be a bad thing or a good thing, but I mean, can we even think of this as a pension scheme at all, as opposed to a savings pot, and it might just as well be an ISA?
I should just blow the gaff here. Paul and I chatted about how we were going to handle this session. So Paul said, we'll kick off with the state pension, go through the triumph of the single-tier reforms, and dwell on that for a while. Then we'll do what a success auto-enrolment's been and how well that went. And then I'll probe you a bit on pension freedoms. But we got to that bit quite quickly. I guess the first thing I'd say is, and I've just said it on video on your little clip, is the one thing pension freedoms did was pensions suddenly became attractive, flexible, interesting. You had workplaces where people were in DB saying, I wish I was in the DB bit. Now, there are issues about that. But, the idea that this is your money, to actually get HMRC to acknowledge finally it's your money was miraculous. That people, for me, the biggest barrier to pensions and talking about pensions has been the finger wagging, that we say to people, put that latte down. If you want to not have cat food when you're old, put that latte down, put your avocado down, save a pension. Now we can say, look, this thing is your pot of money, you choose, the state's not terribly bothered, because actually you're going to get a flat rate pension that's going to keep you, as Beveridge said, at that bare minimum. Yes, help with rent and all the rest of it, but that, so actually the state's moderately relaxed about what you do with the pot. Yes, we should have more guidance, advice, and all the rest of it, but actually I think the behavioural bit people miss is that people who make sacrifices in their working life to build up a decent pension pot don't become reckless spendthrifts when they start drawing on it. Actually, there's a correlation between a decent pot and measured behaviour in retirement. And frankly, if people have got a small pot, it's pretty irrelevant what they do with it. If they've got a decent one, on average, they'll be quite measured with it.
But is it a pension? Or does it matter?
I don't care, really. I mean, so said the former pensions minister. I mean, so you're helping people do something they wouldn't otherwise do. Take away from their consumption now to have consumption later. I absolutely think there is an issue about guidance and advice and all that kind of stuff. And I do think we've touched briefly on cognitive decline and all of that. The one mea culpa, I guess, is we really don't yet have an answer to pension freedoms in a world where people aren't necessarily well equipped to make good choices. Now, in a sense, it didn't matter that you were letting 55-year-olds make these choices because everybody else had already bought their annuity, but it's going to start mattering, and at some point we have to fix that.
Fix what? Fix how you deal with people who are finding it difficult to make a decision?
You might have later life defaults that go into an annuity, or you might have parameters on drawdown products that you can't go outside without advice or guidance. So, you could think of ways you could protect people in later life. So that's work still outstanding, I think.
Well, let's go on to the triumph there.
Did I mention that? Yeah, okay. If we must.
So with the, one of the things that John Kay did, actually, the second director of the IFS in the early 1980s, was talk about SERPs and how it was unlikely to be sustainable, given that the government at the time had decided to stop the projections, I think, at the year 2000, and actually it got rather more expensive after that. You finally put it out of its misery.
I did. Yes. Yeah. So I took the view that we should work out again, as with Beveridge, he said modestly, work out what the role of the state is. And for me, the state was there to redistribute, was to meet the needs of the people the market wasn't going to meet the needs of, and therefore paying a decent state pension across the board, ideally, enough to live on. That seems to me that's what the state was there for. I have never understood why the state was in the business of earnings-related pension provision, unfunded. Funded, you could have an argument about, but unfunded state earnings-related pensions were simply replicating through the state the inequalities of the wage distribution. Well, the private sector can do that perfectly well, and at least when the private sector does it, you've got a property right. So for me, it was about saying to people, my income in retirement is based on a promise from the government, which I hope my kids will keep, and a set of property rights that belong to me. And that's a good spreading of risk. Because I used to have a Labour MP, Ronnie something or other, who every DWP questions used to say, why don't you just keep SERPs? Why don't you want the whole system? Why do you have all this private nonsense? I don't want my future retirement income to be 100% based on an unfunded promise, because it ain't going to be kept.
So some distribution of risk there. I mean, one of the worries, of course, with the end of final salary schemes is that it's no longer that three-bit, it's no longer individual, state and employer, it's just individual and state.
Yeah, I mean, I think we should expect employers to do more, and that might be capitalised on wages in due course. But so we certainly want employers to be doing more. I think we should encourage employers to do more matching and all that kind of stuff, so putting more in. And then, of course, it's not like you can't buy an annuity if you don't. Banned annuities. People who really want that certainty. Yes, I know annuity rate's terrible, but, people who want that, it's still available to them. I think much of the problem with annuities is people buying them too soon. So we don't yet know, do we, whether we'll see people buying annuities at 75 or whatever. So, yes, the individual's got more of the risk, and CDC and so on might be an option for sharing that in some cases. But can you imagine a world where employers are going to willingly take back this risk? I can't.
No, nor can I, no. Finally, so you talked about the role of the state and why it should be focused on a basic pension and the rest should be private. What about public sector pensions then? I mean, they are the last man standing in terms of final salary or defined benefit schemes. Does it worry you at all that there's such a divergence now between what the public sector offers and what the private sector offers?
My regular experience in life is to go to city events, and usually when the wine has flowed, someone red-faced jabs a finger at me and says, why don't you do something about these generous public sector pensions? And I say, well, we took roughly £250 billion out, and kind of I'm a bit old-fashioned, and that seems like quite a lot of money to me. So when we started in 2010, nurses, teachers and civil servants could get a pension at 60, leave aside police and firefighters, so 60. A nurse starting today would probably get a pension at 68, 69 or 70, so that's about a quarter of that pension gone. We've flipped to CPI, etc., etc. Now, yes, it's still a bastion of DB, but I still recall at the 2015 general election a conversation which probably explains why I'm sitting here, when a teacher came in to see me and said, OK, Mr. Webb, just run this by me. So I've had 5 years of near pay freeze. I'm having to work for longer. I've got to put more in and I'll get less out. Just remind me why I should vote for you. So, a lot has happened in public sector pensions, but with a slow burn. And indeed, if the courts have their way, an even slower burn. But it's not like public sector pensions haven't been addressed. And there is an issue about, do you just completely level down? I think salary-related pensions are great if we can afford them and make them sustainable. And I think a lot's been done to public sector pensions that makes them more sustainable.
But they remain. I guess one of the, a sort of wider question is there's just a very different labour market now between public and private sector.
Yeah.
They look more different than they did 20 or 30 years ago.
I guess you've got, I didn't realise the IFS position was that DB should go in the public sector.
No, I'm asking you questions. So, I'm Robin Day here, not. Well,
that shows your age. I think you're Fiona Bruce.
Fiona Bruce. All right, that's much better.
But if you think about the transition, so if what one was saying was, because it's hard to envisage funded public sector DC, so presumably you'd be moving from unfunded public sector DB to funded public sector DC, as in, well, which generation is going to pay twice then?
Well, indeed.
I often get calls from a certain mid-market national newspaper every time there's some figures come out and they say, isn't it a disgrace, shouldn't we scrap all these public sector pensions and shouldn't they just pay into a private pension like everybody else? And I say, well, that's fine, so who's going to pay for all the retired nurses and the retired teachers and retired civil servants? Are your readers happy to pay more tax? And they go a bit quiet and they don't quote me.
Well, that's a triumph. Carl, you talked about, obviously the role of earnings. How much do we know about the extent to which people are actually, as we've talked about, since Steve and I were young men, people that are sort of talking about a gradual glide path into retirement, moving to part-time and multiple jobs and gradually becoming. Is that now a reality?
It's increasingly common. In particular, one of the things that defined contribution pensions allows is for people to, it's more easy to phase out of the labour market. And I think for what we see in the data is for both men and women who are working full-time at older ages, if they're in a DC scheme, they're actually more likely to transit out via part-time employment than to just drop out of the labour market entirely. That's not to say we won't see more of that in future, but it has become increasingly common.
And among particular groups, is this the sort of, the white-collar, middle-class professional route, or is this a broader, more broadly used?
I don't know about that, but when we saw the increase in the female state pension age, for example, we saw an increase in both full-time and part-time employment from that, and that was roughly in proportion to the sort of the extent to which women at age 60 were working full or part-time already. So it's across both genders, and it's particularly common amongst those in DC schemes.
Your chart showing this cliff edge, when you get to state pension age, everything becomes much more generous than it was just below. In terms of responding to that, presumably we have to have a pension age. But are you suggesting a sort of glide path into these kind of benefit rates?
Yeah, I think as we increasingly make the state pension more generous, part of Steve's legacy, and if we're going to continue inflation indexing working age benefits, we'll make that gap bigger and bigger and bigger. And I guess I'm saying, well, actually, perhaps smaller situation might be better. You could consider, for example, people who apply for employment and support allowance or its equivalent in universal credits. That's the benefit for working age people who are deemed unable to work because of their health. You could say if you're within 2 or 3 years of the state pension age, we'll just put you in what's called the support group, rather than putting some of you in what's called the work-related activity group. Now, that gets you more income per week. It also gets you less requirements in terms of what you have to do to get that benefit. So you could imagine a situation where the state was just a bit more generous to those approaching the state pension age on disability benefits. You could even do it on unemployment benefit if you wanted to, either in terms of the amount we're paying or perhaps some of the requirements. I mean, if you're a few months off the state pension age, do we want you to seek work for 35 hours a week? Is that the best use of your time? I'm not sure it is.
Okay, before I come to the audience, I just turn back to Sarah for one last question. So we know that, as we say, people are living longer through retirement. Do we know much about how they use their income as they get older and older, or how they use their income as they maybe become less healthy, and the extent to which maybe, I mean, does a 90-year-old need more or less than a 70-year-old to reach an appropriate standard of living?
Well, I mean, I suppose it really also comes back to this health question, because, and I think that's something that people, well, I think there are two things people don't factor. One, and it's something that Carl brought up, is that there are huge expectations about people coming into retirement that are possibly quite realistic going forward because they look at what happened particularly to their parents. And as a consequence, I don't think we have a very financially literate population, to be perfectly honest, who really understand, and in a way it isn't their fault, but that because people don't quite understand how much money they're going to have to keep in order to look after their care. And of course, we now have increasing numbers of people being cared for in their homes. We have increasing numbers of people who I think actually are believing that, in a way, what is the point of saving for my social care? Because to be perfectly honest, if I save, it'll all go. Whereas because the goalposts are moving or they're not well defined, there is an idea, well, actually, I must well spend down because then I'll probably get some free social care. So I'm not an expert because I'm not a financial person, so I'm sure there are surveys who are telling us how people spend their income, but all I do know is that there is a real sort of insecurity among many people in younger old ages in being able to understand how much money do we need for our health care and particularly our social care going forward.
But uncertainty and worry about that rather than perhaps just lack of knowledge about how much they might need, if they happen to live to 95, even in good health, how to manage a pot of money to keep them going.
Yes, I mean, again, because I'm not a financial person, I mean, I think financial advice to older adults has increased. I mean, we definitely are doing some work at the moment looking at vulnerability among the oldest old. And of course, there is a huge gender difference still. I think that will go, but when we look at the cohorts coming into later life now, there is a difference between the vulnerability of older women and older men, simply just because of often a tradition of being able to a sort of plan and the fact that men in many older couples have tended. And of course, the fact that women tend to go into disability earlier than men. The really big change we've seen over the last 2 decades in particular is that a lot of the things that used to kill men now don't. So we know that couples are living longer together, and we know that women are still much more likely to go into disability.
I mean, that point about couples staying together longer is something that really dramatically came out of some work we did 2 or 3 years ago, which was really, really striking, that the number of older singles is falling and is likely to continue to fall. And that makes a big difference to actually how people live.
And also, we tend to discount the number of older men who are carers. And, you know, particularly men in their 70s and 80s are, in this particular cohort, are doing the kind of care activities that in previous cohorts we just thought of women or children doing. And I think that's made a difference, particularly in their ability, necessarily to earn other income.
Right. Well, I'd love to keep chatting, but we probably ought to let other people have a go. So if you could raise your hand if you have a question or contribution to make, and if you could say who you are and where you're from, that would be great. Gentleman here, and wave a lot because they're very bright lights. It's quite hard for me to see. Okay, there's one up top.
Cameron Farugi, thank you all very much for your contributions tonight. Very interesting. I have one observation that will lead to a question, and it relates, Carl, to your last conclusion. What I don't see talked much is the number and size of means-tested benefits that are out there at the moment. And my understanding, although I'm not as close as others, is that those have increased a lot over the years. And I always think you need to look at both sides of the equation, both the income and the benefits. And I do wonder, once you allowed for those, whether the gap and generosity conclusion that you described at the end might be reduced. So I don't know if you want to comment on that. That comes to a question that I have mainly for Sir Steve Webb, but for all of you, around the complexity that we're now left with in the area of guidance and advice, particularly for that sort of lower to mass middle, where the danger in this sort of new world of individuals making their choice is that anyone on those sorts of means-tested benefits face very awkward decisions about if they don't take out an annuity and do other things, if they're not careful, they will lose those means-tested benefits. And there isn't enough money to get the advice to get a full understanding of their circumstances to address that challenge. And so my sense is that that is starting to happen more and more in new pensions freedoms world.
Okay, thank you very much. Well, Carl, do you want to go first and answer the question about how means-tested benefits play into your story?
Yeah, so in terms of the generosity of the system, I was plotting the generosity of means-tested benefits to people who are just below the state pension age compared to just above it. So it's people who are on a low income claiming the benefits to which they're entitled to. And we do see that play out in their incomes. So it was means testing that I was focusing on, the what's happening to low income people as they're just below or just above the state pension age. In terms of your subsequent question, I guess, and it follows up a little bit of what we were talking about earlier, I think for under automatic enrolment, of course, we're providing people with a nudge to save while they're working. And I guess in terms of pension freedoms, I worry a bit that we haven't designed a kind of, we don't seem to have designed very much in terms of a default strategy for decumulating. And rather than people getting to pension age or retiring and then spending the whole lot, I probably worry a bit about people being too cautious and not running the pot down fast enough, and then perhaps getting to an older age and then regretting that they didn't have a bit more fun when they were younger. So I think maybe we can do a bit better in perhaps providing people with some a steer on perhaps how they want to run that pot down, rather than, for example, a strategy of just spending the interest, which would be far too cautious.
Steve?
Yeah, I mean, I think Carl's point about the difference between the generosity of the means-tested system for people just under and just over pension age is well made, and the gap is absolutely staggering now. So if I tell you that a couple on universal credit has a lower income level than a single person on pension credit. So 2 adults below pension age are expected to live on less than 1 person over pension age, which is just barking. And this has been shown acutely in the discussion about what they call mixed age couples, where one's above and one's below. And until recently, if one was above, you were a pensioner couple and you got the pensioner rate. And now, if one's below, you're a non-pensioner couple. And I advocated in government unsuccessfully for some sort of intermediate rate that says, well, if one of them's over pension age, then all right, maybe you don't pay them the couple pensioner rate, but you don't pay them the non-pension rate either. And that would have been another one of these mitigations. So I do think the challenge, of course, is as soon as you start paying more money to 63-year-olds who are kind of not very well but could do a bit of work, you get everybody on those. That's the challenge, I think. Just on your other point, I mean, ironically, I think there's the issue you raise about, what if I buy an annuity and deprive myself of means-tested benefits is much less of an issue now than it was before, because instead of the basic state pension being 30 quid below the poverty line, it's at the poverty line now. So newly retired people who come in on a full flat rate pension or at the pension credit level, if they then buy all right, there's a rent rebate issue, I take that, but they've got an auto-enrollment pension on top, they are less likely to see this money clawed back, because we're focusing all of the state's resources on getting people up to that basic level, and then if you have saved, you will be better off pretty much, which we didn't used to be able to say. So, but you're right about guidance and advice. There's no way capital A advice will be viable for an awful lot of people with modest pension. It's inconceivable how that would work. But as Carl says, nudges, defaults, all that kind of stuff, we can do more. One last point, Paul. The FCA's research into pension freedoms said sports car sales unaffected, reckless caution, big problem. People who take no advice, stick it in a blooming cash ISA, get 0 point diddly squat interest. That's the problem.
Okay. Did you want to add anything? There's a lady up here.
I'm Mary Dashevsky, and I write about these sort of things from time to time, including in The Independent. two things that I have a particular response to when I write about them. One of them is the disparity between private and public sector pensions, and there is a lot of resentment on either side, but you've sort of dealt with that. But something else is an attitude question, which I had not anticipated at all. But people getting the state pension really resent the state pension being classified as a benefit in the tables of state benefits, and then being accused of pensioners as basically hogging the whole of the state budget. And they feel, and you know, I have huge sympathy with this, that actually it's not a benefit. It's one of the few remaining contributory benefits that people get. And I think it would help if it were put in a different category.
Sarah, do you have a view on that?
I mean, I think that is absolutely true, that one of the problems we have, and it comes back to this when I was talking about this, you know, increased, I think, a tension between the generations that I think to a certain extent is actually being promoted, is the fact that people forget that people who are on a state pension have contributed to this state pension. And in fact, I like your idea very much that actually maybe we need a terminology change going forward, because no, I mean, our research has shown very similar kind of reaction that, you know, I did actually work and contribute to this, and now in a way I'm almost being penalised because I'm taking a benefit from the state. So yes.
Steve, do you agree with that? I mean, do you think that it's is genuinely a contributory system?
Well, we had a dilemma in introducing the single-tier pension. Do we just go the whole hog and make it a citizen's pension? And the Tories would never have worn it, so we didn't. But the
you came pretty close.
It was, well, exactly. I got smuggled as much past them as I could, really. So you know, actually, ironically, you now need 35 years, not 30. So it's in many ways there's more of a link between what you put in and what you take out. The difference between what we do and what Beveridge did is we say there's a whole bunch of things that aren't paid work that we value, bringing up kids, being a carer, and all that kind of stuff, which we also credit. And my proudest boast about the new state pension is a year as a carer earns you exactly as much state pension as a year running a FTSE 100 company. Society now gives you earn exactly as much state pension from doing the one as from doing the other, and I'm really proud of that. And so I believe me, I've had the letters that you've had. The legislation describes the retirement pension as a benefit, but it's contributory. You know, it's contributory. You've earned it. You should get it. And I've written a piece for the Express tomorrow about pension credit. And actually, I think blooming well claim your pension credit while you're at it. You've paid your taxes. It's part of the system. Yeah. You should feel no reticence. So I absolutely think the state pensions, you're right. You've earned it. It's contributory. And I actually also think pension credit people shouldn't hesitate to claim either.
Well, that's my. I mean, is there really that sharp difference between the two? I mean, you know, it's pretty hard to avoid getting a full state pension now, unless you spend time out of the country or are idle rich, essentially. So, I mean,
poets and prisoners, basically.
Poets and prisoners,
yeah.
Exactly. And you, as you say, you've earned your pension credit as well because you've contributed to society through your life. I mean, I know that this is how people think, but it worries me that they have this. I think really sort of inappropriately divergent view about the difference between this kind of benefit and that kind of benefit, and it has potentially negative effects on the way that we communicate and design these things. Lady at the top.
So with people working now after state pension age, should they be paying national insurance contributions past state pension age?
Minister, former minister.
Yes.
Yes.
Clearly a former minister.
Yeah. Can't think why not. It's all tax, isn't it, really?
Does anyone want to disagree with that? Do either of you want to disagree with that very clear and honest answer?
I mean, to go further, there is a set of we have income tax and national insurance contributions that are levied on the amount of money your employer is giving you. The biggest thing that's not subject to national insurance is the pension contribution the employer is making on your behalf. So I think there is a case for some levy of national insurance contributions on pension contributions. They're just deferred wages. It's not obvious why they should escape national insurance in their entirety. And if you think, well, actually, we need some financial incentive to encourage people to save, this doesn't feel like a very good one because it's really very, very opaque, and it doesn't feel like one that's been carefully targeted at, for example, the people who are under saving or who we might be most worried about.
You said that national insurance on the pension contributions rather than the pensions in payment, I mean, which I personally would prefer.
You could do either. Clearly the problem with pensions, well, an attraction about pensions in payment might be that this is a generation who, the generation of people who are getting large amounts of private pension income have done very well out of a system. You might think that's a just thing to go and do, but of course it would be somewhat retrospective. They would have accumulated their pots not expecting to have to pay it. And I think that's the trade-off you face there.
Indeed. Right. And just in front of that last questioner, and then I'll come to this side.
Paul Wallace, I'm a journalist. A question for Carl and also for Steve, if I may. Carl, the experience of America, which is ahead of us in the demographic curve, is that employment rates haven't risen. There's been this stagnation in labour force participation. So why should we necessarily assume that employment rates can just carry on rising? And so, Steve, I also attended at the IFS presentation by Mark Pearson from the OECD, and my recollection is that he said that looking forward, the British pension system was about the least generous among all the ones that he surveyed. So I just find it difficult to square that with your interpretation of it.
Right. So, Carl, why don't we start with the first of those questions? Can we really? I mean, is this realistic, given other countries' experience?
Well, for most other OECD countries, we also see, interestingly, an increase in employment rates at older ages since about 1995. And it's not like all of these countries introduced some big bang reform in 1995 and it's had that effect. It's just something that's happened as people have aged, as time has gone on, people perhaps have got more able to work, perhaps because of changes in the labour market. So it's a trend that's common across many, many advanced economies. I think for men, as I showed, I think you have to have an answer for how were employment rates so high for older men in the 1970s, and why do we think that we couldn't possibly get back to that level if we wanted to? I'm not saying we necessarily want to get there, but I think we could do. For women, actually, if you plot the employment rates throughout their lives of women born in the 1960s or women born in the 1970s, you see that they have higher employment rates than their predecessors at all ages they've been through so far. So they're already tracking a kind of path where they've got more labour market attachment, which I think will translate into later retirement ages.
Steve, Mark Pearson from the OECD, also another alumnus of the IFS, says that we're still meaner than everyone else.
Yeah, well, he would, wouldn't he, really? No, seriously, so two questions. First of all, just the UK in isolation. So what would a good enough, generous enough pension system look like? Well, a rule of thumb might be that if we take the average earner, we deliver to them through state and private provision, let's say 2/3 of what they had before they retired, because you don't in retirement pay you, hopefully, your mortgage, your childcare costs, your travel to work costs, your national insurance, etc. So 2/3 of what you had before gross should be roughly there or thereabouts. Now, the £9,000 flat rate state pension, brackets which used to be about 6,000, plus SERPs, is about a third of the national, I know it's is a third of the national average wage. So we're a third of the way there with a full flat rate pension. Auto-enrolment for a decent run probably gets you another sixth-ish at current contribution levels. So we're short of that last sixth. And that's why I think the 8% of band earnings needs to be 10% and more of full earnings. I think if we do all of that, then your average earner who does a full working life of what I've just described will end up with roughly 2/3 of the national average wage. And that seems to me kind of a reasonable goal. Now, you could say it should be more generous, and international comparisons are fraught with difficulty, because A, free NHS, for example, where you look at the states and you think, oh, generous pensions in the states, but then they've got to pay for their health and so on. So we have to be a bit careful. But it is true, Scandinavian voters vote for parties who will tax them more than British voters do. Again, that's why I'm sitting here. So, you pay, if you want to live in, it's the classic one. If you want to live in a social democratic country with social democratic levels of public services, you have to vote for social democrats or choose social democrat tax levels. We don't do that in this country, and that's why the pension is as it is.
Well, let's not discuss who we might end up voting for. Sarah, I think you wanted to say something a bit more on the actual likelihood of more people working.
Yes, I mean, because I just wanted to build on something that Carl had said, because it isn't just about desire of older adults to keep on working, it's actually the demand for older adults. And I think we have to put it in the context that obviously the labour market is changing tremendously, and the labour market in this country potentially, and job opportunities are changing, through technology, and already I think earlier on somebody commented on the fact that of course technology will take away jobs, it will take away tasks, it will rebundle tasks. One of the reasons why older adults are actually, they can stay in the labour market, particularly manual workers, is because a lot of manual hard labour has actually become now robotics using a computer. And so to a certain extent, yes, there are some jobs that older adults will be able to continue to do, but I think when we look at the whole labour market and how that's going to change and how technology is going to change that, particularly when we're going to have younger adults who may find that there are less labour opportunities, we may well find society coming in and saying, well, maybe jobs should be available for younger rather than older adults, and we don't know how that's going to play out. And then, of course, there's a whole question of migration, because we know in this country, if we're going to start cutting back on migration, then we're going to need older adults, particularly in the care sector, to come forward. So I think it is the demand for jobs and how older adults are going to fit into that is actually a context which is going to play out behind this.
Right. Tom Schiller up here. The most awkward place in the room.
Tom Schiller. I was interested in the points about the glide path and the transition to part-time employment. And I want to ask a very simple question just about what the volume of that actually is and how fast it's growing. But just to raise an issue, which is, in my view, part-time careers is a sort of part-time status is a death knell on careers for people, particularly for women, who therefore suffer across their working lives. And so would the growth of part-time employment as a sort of glide path out of employment, not serious work, further impair the status of part-time employment earlier in life?
Well, that's an interesting question. I mean, we do know from other work we've done at the IFS that you're absolutely right. I mean, moving to part-time work is disastrous, actually, for future earnings growth. And that's one of the big reasons why women's wages are lower than men's. But I hadn't thought about it in the way that you just described it. Do any of my fellow panelists have a thought about whether this might be dangerous?
Well, you could make the opposite argument. You could say that as soon as men experience things that women experience, things change. Yes, I think I'm agreeing with you in that case. So, once the issues around part-time work are experienced by older men, it might be that part-time work becomes actually much more mainstream, and then we think about how we integrate it and give it status and all of the rest of it. We don't deprive part-time workers of the chance to train because they're part-time, because that sort of thing would go. I appreciate that, but they might be pretty well connected.
Sarah.
And I was just thinking of the sort of labour market change in particular, and we know among younger people that there is a huge growth in entrepreneurship, wanting to set up SMEs, etc. So this idea that you have full-time employment that is across a career is something that younger cohorts very much are beginning to move away from, and therefore possibly things like flexible working, part-time work will going forward actually begin to change how we view part-time work for all ages.
Related to this, just an observation about the way in which people often go from full-time to part-time, which I think relates to how our labour market works. Quite often it's not staying with the same employer and reducing hours. Quite often what happens, and this is true at younger ages too, is that somebody who wants to change their hours goes and works for somebody else, and it's a job move to facilitate, for example, a reduction in hours, and that's quite common at older ages too.
There's one up the back here.
Ed Smith from Rathbones Investment Management. Younger generations are going to be less likely to be owning their own home at the age of retirement, and a greater proportion of those that do are going to still have a mortgage. So therefore, they're going to need to have saved more during their working lives in order to maintain the consumption patterns of their predecessors, because they're getting less of the income in kind from living rent or mortgage free in retirement. And I wonder if you could comment on the policy implications of that and how that affects sort of retirement income adjusted for these things. And so I also just quickly wondered if you could comment on the amount of unfunded pension promises, state pension promises in the UK, and together with the OBR's projections for other age-related spending, how that is kind of massively affect fiscal policy going forward.
Well, it's remarkable, isn't it? We've said very little about housing so far, so now is the chance. Sarah, you look like you want to go on that one.
Well, yeah, just because that's something that we sort of looked at when we were doing this social care green paper, and I think there is an assumption, and the big assumption you have made is that on retirement, younger cohorts will probably not be owning their houses or will be less likely to own, because I think they will start going to house ownership later. But I think that we're going to find there is going to be a catch-up with this cohort. And I think the more important thing is the huge inequalities within, if you like, families. I mean, generational transmission, if anything, is across the socioeconomic groups just getting wider and wider. So you're going to have a whole sector of the population who are inheriting wealth, particularly housing wealth, unless something extreme happens. And those cohorts are very likely actually to be homeowners. But you're probably going to get a larger group that are not going to inherit housing wealth, and they're the ones who are more vulnerable to still being in probably a reformulated rental. And that's one of the things that I know that the discussions around the social care green paper actually took into account, is housing wealth going forward and how it would spin out between different cohorts.
I think that point about the inequalities within cohorts is really important. One of the things that astonished me is that when we looked at second home ownership and more than that among people in their 50s and 60s, it's incredibly high. And in a sense, it should be obvious, because all the young people renting, they're renting from their parents' sort of generation, and that so that inequality in inheritance going down is going to be very important. But Steve, on the point about the role of housing and the housing benefit and how that might undermine a lot of what we've been talking about,
I wonder if we'll start seeing double generation inheritance. So if I think of my family, my parents are in their 80s, I wish them a long and happy life. At some point, their housing wealth would come to my generation. We don't particularly need it. So will they either skip us anyway, just give it to our kids, or will we immediately bounce it down? We've done a bit of research at Royal London where we surveyed different generations, and we wrote a snappily titled paper which was called "Will Harassed Baby Boomers Ride to the Rescue of Generation Rent?" And to which the answer was roughly yes. So there was a bunch of baby boomers who will inherit this housing wealth. They'll be blooming 60 when they inherit this housing wealth. They largely won't need it. Will it bounce down? And does that start to make up some of the things that Sarah talks about? Just on the unfunded state pension. So the new state pension takes about 0.5% of GDP out of future liabilities by the middle of the century. So it takes out the growth in SERPs. So it is a way of getting things under control. Couple that with state pension age rising in line with longevity, and the state pension age, when the OBR predict the future costs of an ageing society as a percentage of GDP, the state pension goes up a bit. Public sector pensions, goes down because of all the changes that I've mentioned. Social care goes up a bit, and the health service goes off the scale. And my weekly conversation with my elderly parents is a litany of hospital appointments. That is where the cost. I don't think pensions is the real issue of sustainability, it's health.
Yeah, what Steve didn't say much when he was a minister was he actually cut the state pension going forward.
Yeah, I suppose so. Yeah.
On the housing point, I think actually we've talked a bit about automatic enrolment and the rates going in, and if you think back to when the Pensions Commission did those calculations, well, lots have changed since then. We've had a financial crisis, we've had much weaker earnings growth than you'd have expected, we've had a new single-tier pension come along, we've had interest rates look low for a long while. And of course, the other thing that's changed is the outlook for the housing market is very different. And I think Steve may be right that maybe some people will get on the housing ladder when their parents or their grandparents bequeath them money, but that won't be true of everyone. There'll be some people whose parents grandparents didn't own a house in London and the southeast, and there won't be that much wealth to go around. And one policy consequence could be that actually the state ends up on the tab for the housing benefit. We could end up with more people in retirement in the private rented sector, and housing benefit bills there are pretty expensive. So certainly for the long-term public finances, I think that may well be a concern, and we may need to think through again about, again, the automatic enrolment rates and the future of means testing of retirement incomes and what role housing benefit is likely to play.
Could I be a bit cheeky, Paul, because we've lined up a slide. Can I press the slide button?
You may.
Would you mind? So, and it comes back to something Sarah said, and we hadn't collaborated on this, but this is Carl's pensioner income slide, and I just think there is a risk in this conversation that we say, pensioners were hay, that we've seen all that decade-long compression, and suddenly they're on average, no worse off than anybody else, and if anything, slightly winning the game. But that chart is 50, I can't see, 60 years, 50 years, something like that. That's a hell of a long period. Look at that last decade. It stopped. Now, what we don't know is that just a breathing space, and it's going to go mad again? I don't think it is. I just wonder if we're at a turning point. So the death of DB, long prophesied, never quite arrived, maybe has just started to arrive. DC cavalry hasn't arrived, and maybe, Paul and his colleagues at the IFS loathe the triple lock, which was actually a triumph of optimization under constraints.
I do understand the political economy.
But, wouldn't it be ironic if we switched it off, or stuff like that, just at the point that line started going down?
And the one point I'd like to, what's really striking about that chart is that, as you see, it's showing that pensioners today are as well off in terms of their income as people of working age. Given that incomes rise over time, that tells you that pensioners today are on average better off than they were when they were of working age by some significant margin, actually. And you see that by doing however you kind of do that do that calculation. You always find that the pensioners today are better off on average than they were when they were 40. We're right at the end, so let me collect a couple of questions. There's one, two. I'm not going to give you a chance this time. Right up there, sorry.
Sandy Anderson. The risks of longevity and health are so variable between people that mutuality, whether through the state or privately, has to be a big part of the answer. We used to have a system where the person making the sacrifice, sacrificing the income, got the tax relief, and the person receiving the pension paid the tax. And this has been rather turned on its head over the years. But that worked with the grain of human nature. It also worked very well in terms of public finance, in that the state was forced to forego income when people were younger and receive it when they were older and needing the benefits. And politicians have been able to get away with this because we don't have a national balance sheet in the accounts showing the damage this has done to public finances.
Okay.
I wonder what the panel's comments.
Great. So that's one question about the tax system. There were a couple up here.
Picking up on the comments on auto-enrolment, do you think there's a danger in the narrative that the combination of auto-enrolment and state pension is sufficient? And do you think that narrative is stopping, to a degree, companies giving it the priorities that they might?
Okay, so one on tax, one on auto-enrolment, making us complacent, which is a word politicians hate to be called. And there's a lady up here, and I'm afraid we'll stop there.
I wanted to ask if we could have a publication of the costs of the state pension after tax has been paid on it, because it is grossly overinflated, the figure which they publish, because it's net of tax payable, whereas the other benefits are not, in effect, taxable. A huge proportion comes back of the state pension in tax.
Okay. So a question, yeah. I think we get the question, thank you. So this is the last chance for each of you. So we've got three questions here. One about I think the diminution of tax advantages on the way in relative to the way out, and is that fiscally sound? One about, do we account for the state pension properly because we because we tax it. And because I have a brain like a sieve, I've already forgotten the middle one, which was about auto-enrollment and complacency. Yeah. How could I possibly have forgotten that? Well, let's go this way. Carl, do you want to kick off? And if you have any, each of you, if you have any other final things you want to say, now's your chance, because we're now officially 30 seconds into drinking time.
Okay. So, I mean, I think the situation where we allow people to save in a pension out of their income before tax and then we tax it once they get to retirement has many attractions, one of which is the one you mentioned. Actually, it means that the government is getting the money at the point in time when there's more older people putting a strain on, for example, the NHS and the pensions bill. So I think it helps management of the public finances, and I think it's certainly unfortunate we've implemented changes which have brought in more money up front than what they will do in the long run. So there has to be a concern that we've weakened the long-run public finances by doing that. On automatic enrolment, actually, I think the evidence so far is that it's been about as successful as you could have imagined, perhaps a bit more successful than we could have imagined. I think there's some crucial stuff we don't know. We don't really know whether people are genuinely spending less as a result of this money being put into a pension. So is it truly driving up the saving rate? And we don't know where that employer contribution is coming from, which I think is very important. But that said, I think that the evidence so far is all pretty positive, and there is a case for, given that enrolment rates are so high, for going further in terms of the contribution rates. And on the final question, you are right that the state pension is taxable. Of course, a figure net of tax will be complicated because people are paying different tax rates. So I think it'd be quite hard to get. Many pensioners won't be paying any income tax on it, given a £12,500 a year personal allowance.
Steve?
Yeah, just to perhaps take them briefly in reverse order. So, as you rightly say, national insurance benefits have always been taxed because they were earnings replacement. So the argument was if you were earning, you pay tax. These are to replace your earnings, you pay tax. Roughly rule of thumb, it used to be the case, certainly when I worked for the IFS, so it may have changed since then, about half of all pensioners pay no tax. And of the remainder, the vast majority pay at the standard rate. So if you said half of pensioners pay no tax and the other half pay at 20%-ish, then roughly 10% of the state pension cost is coming back to the Exchequer in tax. That would be the adjustment you'd have to make to the figures to give the point that you want to make. Complacency in auto-enrolment, yeah, I mean, there are plenty, we talk a lot about 5% and 3% and 8% and all that kind of stuff, but a hell of a lot of employers are going a hell of a lot further. Actually, matching is one of those things we know does work. There isn't much that makes people save more, but knowing that if you put in £1, your employer does, and understanding that does encourage people to save more. So I think you're always going to get a split in the labour market of the bigger employers who see this as part of a benefit package and who will go further, and the chip shop who frankly wouldn't be doing this at all if you didn't make them. So I don't think we're complacent yet, but let's see how it goes. And then just finally on this point about EET and all that kind of stuff. After my time, George Osborne was set free, and he produced a consultation document that, as you know, proposed completely flipping everything to ISA-style treatment. And one of the reasons I and others said that this was balmy was, yes, of course, Chancellor, you want all your tax now, but when everybody's old, you won't have any tax base left. So, which wouldn't have been a great idea, I think.
Sarah?
I can't really comment on such detailed pension policy, but if I have a final comment, I think that we tend to think of this as a national set of policies, and in actual fact, it's just to, again, stress the sort of regional differences, particularly in things like social care. And it isn't just between income groups that we find this huge diversity, but actually between our least affluent or our most deprived area and our least deprived areas. And I think just to illustrate this, that if you are a 65-year-old man living in one of our least deprived areas, you will probably make it to 80, but all your 70s are going to be with a degree of disability. And if you are a 65-year-old man living in one of our most affluent areas, you will probably make it to your late 80s, but you will not go into disability until you hit your 80s. And when you consider that we have local authorities who are picking up that kind of a tab, that behind this big sort of national policy that we tend to think, we really have to think of this at the moment in terms of regions.
Yeah, that's a very good point to end on. And we have lots of work at the IFS also on local government finance and how that's not compatible actually with exactly what Sarah was just describing. Look, it only remains with me to wrap up very quickly, to thank our brilliant speakers, to Carl, Steve and Sarah, who've been absolutely fantastic this evening. To remind you that there is something in this little booklet which tells you how you can support the IFS if you would like to do so. So we do continue for another 50 years with any luck. We have, as I said at the beginning, a couple more of these later in the year, which you will see information about, as well as our annual lecture in September, which again we will send plenty of information about. So there are now drinks available in the other rooms, so you can celebrate 50 years of the IFS, or perhaps just drown your sorrows about the state of politics and English cricket once again. But finally, just thank you very much to our speakers.